And as always, we're going to be looking for accurate context, good risk management, and always exercising good patience.
Everybody who's traded has gone through periods of time where their strategy hasn't worked.
Where if not a hard stop, you should reevaluate the trades you're in based on time.
That's what we're here for, is to put ourselves in the best success. A trading routine does that, builds that habit, lets you know what to work on, what to reflect on, and what to improve on the next day.
Hello, everybody out there. Welcome to Coach's Playbook, because it's Tuesday as usual, and I look like I'm reporting live from a Peruvian jail or something right now. There was meant to be, similar to this morning, a green screen behind me. I'm in the basement. So anyway, today we're talking trading do's and don'ts. Specifically, we had the hook of talking market stop versus market limit stops. We'll get through that pretty quickly. It's an important one, but then we have some other do's and don'ts for you as well. But first, Mick, who's doing well today?
Shout out. We got a big shout out to Lin Chung Fang, up $5,700. NASDAQ as usual. That's what most of our traders are trading. But that's a really good day. And got a nice $22,000 account balance. So things have been working out for Lin. So big shout out to you. Keep up the great work. It's what we love to see.
Great work, Lynn. So, what everyone's anticipating now, Hogue, how should people set their stops?
Okay. Some people are aware of this. Many people are probably not. We've had to teach a lot of folks the difference between the stop limit and the stop market. A stop limit, a stop same limit, can only be filled at its price, at its trigger price. If you get into a situation where you are using a stop same limit or a stop limit, you are not guaranteed to fill. If there's only 5 on the offer and you have a buy stop and there's 6 buy stops ahead of you, you will not be filled. It will turn into a limit order to buy and below the market. If you ever get into a situation of volatility, you may get left behind. It's going to leave you exposed to, whatever risk is in the market. The market has to come back to you to get filled. That is a stop limit. A stop market will get filled. When it's triggered, it turns into a market order. It may not get filled at the trigger price, but it will get filled. We've had a lot of folks in the past, and even trading in the trading combine on some accounts, had their stop limits get left behind, and then they call and say, hey, my stop didn't get filled. It just sat there, and it cost me a lot of money. It's because it was a stop limit. Again, use stop markets. If the price gets to a level where your trade is being proven wrong, get out. Give up a couple of ticks if you have to, but make sure that you're using stop markets versus stop limits. Now, there's different platforms treated differently. Some are a stop limit can only be filled at its trigger price. And again, if there's not enough offers or bids at that price, it's going to leave you behind. A stop market turns into a market order and may not get filled at its trigger price, but at the very least, you're out and you're protected.
Now, you might be thinking, I thought this would be a super short part of it, but there is a little more info here. You might be thinking, why does the stop limit exist? And I think there are obviously situations for that I'll explain shortly, but you should not, as an outright trader in the futures market, day trader, should probably not be in this sort of position. I'll give an example of when I was trading spreads, there'd be versions of sort of stop limit where you would set your maximum puke on the stop order, meaning that you would say something like, okay, it hits this price, hit it, but only pay down, and then you would just insert the number of ticks. Where this is beneficial is if you are trading illiquid markets, I usually saw it in terms of spreads. The usual case for using a stop like that is, say you're there right on the open, you're 22 years old, working overnight. The markets are just opening, and it is your job, and you will be berated if you don't get the fills you're required to at a price that trades. So you're being aggressive as the market is thin. And you're trading something where if it gets hit on one side, it will get hedged in the other. Well, the problem is that could be very dangerous to have market orders around, because if you get hit in one thing, there may not be orders for many, many levels. And it's not because the market's moving quickly. It's just because they haven't filled in yet. So as sort of we call them night settings, insurance against the disaster of, say, puking. I've seen stuff like this done before. Puking a whole handle or something in the bonds, which would be very, very bad.
Expensive.
You have very expensive. I once saw someone flipping a ticket, feeding through, like, lost $27,000 in a couple of minutes, just feeding through 7-year spreads. The point being that those stop limits are actually for slow markets. They're for illiquid markets to make sure you don't have some sort of catastrophic fill. If you're trading during the day, that should never be a problem. And generally, if you're trading the products that y'all do, equity indices, things that are liquid like that, it's never going to be worth it to have that stop limit. You're just going to want to get out, because, as said, if things rip one direction, say there's a headline risk where things really go, you'll be left behind completely open, and that is a dangerous place to be. So use the stop market. That's why stop limits exist.
Yeah, we use stop limits all the time on the option side because of our delta. If our delta changes, and sometimes we're long a heavy amount of premium, if we move a 10 tick and we have a market order and that bond market moves rather quickly and we miss a fill, what we're looking for is we're going to change how our position's hedged to adjust our delta on 10 ticks. We may actually decide, you know what, we're going to get out of a little premium here. Maybe we'll hedge with different options as opposed to using that futures product. So we kept limits on as opposed to markets if there was ever slippage, because every tick, it's a massive dollar value on risk.
Yeah, we have a chat question in here right before you go, Mick. I just wanted to answer this really quick. Someone's asked, I've heard that stop limits turn into market orders.
No, stop orders or stop market orders trigger when the price is traded and turn into a market order. Stop limit is limited to the price that you set it at.
Yeah, they might even be talking kind of what I explained of some kind of limit order that, like a double stop type thing. Like, it goes to a stop limit, but if it chases enough, it goes.
Right. There's stop market, stop limit, which is only that price can be filled if it gets filled. That stop same limit. And then certain platforms have a certain number of ticks or points that you'll allow slippage before it stops.
You predetermine, I want to be limited to this price, but I can say, it can fill within 6 ticks of my stop price.
Right. And I don't think DS Trader has that. It's either stop limit, same limit, or stop market.
And once again, can't say enough that you should not be trading at times where that's a consideration. If you're just trading futures, those are liquid, and the only time they get illiquid would be right before an FOMC announcement or a CPI number, or another time that you shouldn't be in a position that your stop loss is getting triggered, because you'll get a lot of slippage there too, but all bad situations. So just be aware of what those are and how those work. Now, we also, because that's a pretty straightforward topic, wanted to talk about, well, Mick, you look eager.
If I may, I think about my shout out. So with the stop limit orders, I mentioned my shout out today, the guy who's up a lot of money trading the NASDAQ. So with the stop limit orders, think about the market that you're trading and how thin it may be. Something like the NASDAQ that's, single digits on the bid and offer, is a little bit different than the S&Ps, which are a much deeper market, where you might see hundreds and hundreds on the bid or offer. The S&P moves a little bit more slowly. So when, you know, the buyers or sellers are more aggressive and they're chewing up those bids or offers, there's going to be a lot more trading at that price. So your odds of getting filled on a stop limit in a market like the S&Ps are much greater than the odds of, you know, getting filled on a stop limit in a market that's as thin as the NASDAQ and goes flying around. As I like to say, you get left in the dust. And I did want to talk about one other scenario. I know Jack and John had mentioned, you know, I've used stop limits in the past when looking for breakout trades for entry. They're not protective stops, but basically, if I assume that we're going to break out of a range, I could use a stop limit order because I either want to or stagger some stop limit orders at different prices. I want to ensure if I'm looking for a breakout and getting a good fill on that breakout for a trade entry, that I'm either going to get the trade at the price that I want it, or I'm going to get left in the dust because I don't want to use a stop market order, incur slippage, and then end up paying the high price of the range or selling at the low point of the range when there is that breakout to the upside. So I think that almost pertains more so to the retail day traders that might be looking for those breakouts. You know, these order types are tools in your toolbox, and depending on what you're trying to do with your trading, you know, one tool might be better than the other. But in most cases, especially for those that are looking to use these for protection, you want to use a stop market because it guarantees a fill. It doesn't guarantee the price, whereas a stop limit may guarantee the price, but doesn't guarantee a fill.
Excellent point there, Mick, on using stops for entries. Totally different world there.
Exactly. So, Dan, you were active with a few do's or don'ts. Maybe you could throw one on us right now.
Well, we got kind of just touched on the liquid versus illiquid market. The one that I was really thinking about, though, that it's one of those do as I say, don't do as I do type things. So it's a do don't would be do not add to a loser, with a caveat, obviously. So do not add to a loser. And if you're adding to a trade, you always want to add to a winner. Now, one thing to keep in mind is we talk about levels. They are ranges for a lot of us. I'm looking at levels pretty actively throughout the day. It's not a finite number. You know, if I'm looking at a product, lately, everyone knows I've been active in the crude oil. Crude oil right now, trade around that $72.50, $72 handle. If I'm looking at, let's call it $72.50 as a price that I want to enter into a market, it's not a hard level at $72.50. Sorry, I'm hearing background noise. I didn't know what that was from. If it's not $72.50, you know, I have room there. And if the market still goes against me, yeah, for sure, I can get in that trade as long as it's within that defined range. It's when you're trying to get into a trade, if you get into a trade, the market goes against you, and your goal is to lower your average price so it's easier to get back to scratch. When that's your mentality, do not do it. Now, if you're in a trade and the market's moving in a nice trending direction, you know, you found a new level, you found a little bit of a pullback, by all means, add into that winner and continue to ride out that trend throughout the day.
I have no problem with the idea of averaging into a position if that was your plan to begin with. If you want to have a full size of 3 contracts on at 72, you put one on aggressive at 73 or something, 72 and 71, that's fine. But what we see more often is your full size is 1 contract, and then it goes against you, and they're like, well, time to put on another.
Yeah, my strategy is a unit. I have standard units, and that varies, but I usually want to start with a quarter unit or a half a unit and slowly build into my full size. Let that market go against me. I'm okay with taking a little bit of heat because I want to get in the trade. That's my biggest thing, is I want to get in. And if it starts to go against, then I can add on as long as it's within my ranges, as long as within my strategy. I'm not over leveraged and I'm being smart about how I'm getting in. That I'm okay with. And I always start small and I'd like to build in.
I look at it.
Go ahead.
I'm just going to say something quick. It's a thin line between adding to a losing position and acquiring an inventory in a zone.
Yeah.
Exactly right. And that's kind of what I was going to touch on. Like if I have a longer time frame outlook and I want to be buying crude oil between $73 and $72, now there's 100 ticks there. I can scale into it around the upper 72s or 73, and it could trade down to 72. And because I have this outlook and plan for my trade, I wouldn't even call that, a losing trade on my first quarter unit or half unit, because, hey, my plan is to buy in this area of 100 ticks. So while my P&L might be negative at that time, I'm not even considering it a losing trade. I would actually like to see it continue into the lower end of my zone for buying in order to see, more continuation to the upside. Where it's different is obviously if, I go in, I like getting long at 73. I go full unit size at $73, and then it goes against me 26 or 20 cents. And I'm, then they're cannonballing, as we call it, or adding to a losing position kind of at or around my puke level. Because if I go full size, depending on what my risk is, not a lot of people who go all in can risk 100 ticks on a trade when they might only be looking to make, I don't know, 20 ticks on the trade or something like that. So just elaborating a little bit.
Well, it appears we may have lost Hogue again, but it's a jolly image to remember him by, the corner of our Zoom here. Yeah. Oh, there he goes.
He's gone and he's back.
Welcome to the party,
Thought we
Hogue.
lost him for a second there. Darn.
This little guy's got to go.
Yeah, Hogue's fighting Comcast and router problems right now.
Gremlins.
That's another advice for trading is make sure you have a stable internet connection. Right, Hogue?
Yes, absolutely. Absolutely. I've done nothing since Make Hogue money because of that.
Awesome.
Yeah. Well, I know, Dan, you have two internets, don't you?
I have two internets. I don't ever have any problems. Historically, I have been pretty consistent on my internet connection. And just talking about it, another this was something that growing up in this industry, like we were raised by my father that your computer, like Wi-Fi was not a thing when Wi-Fi came out. Like my dad was like, no, you don't need Wi-Fi. Everything's hardwired, because he came from trading and then they rolled into screens from the floor. And that was what he was told, is you hardwire your computer for the best connection. So I remember when like laptops are coming out and like we all wanted Wi-Fi in the house. My dad's like, absolutely not. You will hardwire that laptop. Even to do just basic, AOL and AIM stuff, we were hardwired. And to this day, I promise you, my trading computer is hardwired, doesn't even have access to Wi-Fi.
Yeah, I see we have a comment.
I'm not trading bonds. I'm trying to do my homework here.
Right.
We actually have a comment in the chat from Patrick Wieland that says, an influencer on Twitter said they never use stop losses, though, ... I assume this is sarcasm, but yeah, some people say all sorts of things, but yeah, use stops, man, especially if you're trading outrights. Another thing I'd say is, like, I see this all the time. The price of something rising is not in and of itself a reason to sell it. The price of something falling is not in and of itself a reason to buy it. We can see trade data from everybody in the combine or the funded account. And there's this thing that happens, I think, where if the price goes up, we tend to get a lot of people short in the equity indices. And when the price goes down, we get a lot of people getting long, which is interesting. And there's nothing wrong with fading something if you have some level or some reason for that. But I think sometimes we kind of default to, oh man, this is high, better sell it. What do you guys think on that, Hogue?
Well, it's one of the biggest issues that traders have as they come into trading and all through their trading life. I mean, Dalton says it best. You don't fight a directional market. If you can't get in, stay out. Think about it. Price is moving consistently higher all day. This has been always a challenge for me, is to get into a market that's already moving in one direction. Because it's so hard to do, you kind of default to the other side. Well, if I can't buy it, I better sell it. So you pick the high and you get run over, and you pick the high again and you get run over, and you pick the high again and you get run over. And then you fall into the idea that, well, if I start buying it now, I'm certain to pick the high. So you sell it again and you get run over. So there are times when the right thing to do is to buy higher or sell lower instead of buying lower and selling higher. It's all part of the context of the market and being able to recognize when the market is compressed, when your competitors are one-sided. It's all part of the game. But we always say don't try and catch a knife or a falling knife or whatever it is. And I still catch myself doing it or thinking about doing it now. There was a day last week when I missed the short, and I tried to get short a few times. The market wouldn't let me in. So I immediately start thinking, well, maybe this is the bottom. So you start thinking about buying it and you just take your hand off the mouse and don't do it. So, it's all in the context of the market. I got Lacey here just moosing me.
And I would just add to what John was touching on there too, right? It's like, and Jack, to your question, a lot of people are looking at different time frames. And I think a lot of newer traders like to look at a shorter time frame. If it's a 1 minute, if it's a 5 minute, you're not seeing the full context of the market like John was just talking about. Make sure you're looking at different time frames to get a better concept of where that bigger picture of the market is. I think Mick's always used, the top-down approach, that language. It's really important to do that. If you're looking at shorter time frames, open it up, because in that short time frame, it may look like direction has changed. But as soon as we back it up and we look at, say, a 30-minute, or for me, I'm a big 4-hour guy. I look at the 4-hour chart pretty regularly. There she is.
The wolf.
You'll see a different context or different market state potentially. And maybe that market is just in a little bit of a pullback, trying to get to a direction it wants, or get to a level it wants to get to.
Yeah, Dan, to add to what you were saying, I completely agree. I can't tell you how many times I've spoken to traders who were, like, whoa, what just happened or something. And it's like a market moved 30 ticks or something. And it's like, well, if you were looking at a higher time frame chart, you just would see that we took out the 20-day lows or something like that. Like you're missing the forest staring at the trees, and you're not as fully as informed. You really should be knowing about previous day's high or previous day's low, but you'll never see those if you're looking at a 1 minute chart. So really important there to provide context to the market. And when you're taking risk, it's really important.
Somebody asked in the comments whether any of us use a VPS to trade, which is a virtual private server. I'm going to assume not. Not
I don't even know what that is.
I'm a pea shooter,
Yeah, I haven't had, my internet's been really, I haven't had too many down problems or stuff like that, but I would look into it. I'd like to build a server at some point. Even
sounds like a hefty investment for some trading. I got a phone number I can call if everything gets detrimental and I can get out.
I mean, what are the benefits to that? I could, assume some, but do we know what the real benefits and who would really want to be using those?
I'd have to look into it more. So they're not that expensive. It might be similar. Like, I'm familiar more with obviously VPNs than VPS, but something we'll look into.
And I would say don't use a VPN because that slows everything down.
Yeah, I guess unless you're in a country that doesn't allow trading or something. I don't know.
Yeah.
That's what I was in China for a couple of weeks and had to get the VPN before we went there because else you couldn't get into your Gmail or stuff like that. It was wild.
Looks like we had another question. At what point do you guys move stop to break even, or do you move stop to break even? I'll take that. It's yes. It's not a one size fits all answer though. I mean, it really depends. Like, it's nice moving your stop to break even if you're looking for small, wins, but really, there's a balance between getting your stop to break even and, letting the market breathe enough to, manage and weather those price fluctuations. So that's really more of an art form, in my opinion. And it really, really depends. Like, you have to think about times, like space that you give your trade on time. And that should be, correlated to how long your holding time frames are, or what kind of time frame you're on. So time's important, but you look at any shorter time frame chart, even daily charts, there's a ton of price bar overlap. Like, you have to be able to give that market room to wiggle around and breathe, because many times I've found in my experience, without giving it the room to breathe, you could be dead right, but you get stopped out at break even, before it continues in your favor. So art form, not a one size fits all answer, in my opinion.
Stops are a total art form.
Yeah, and
And
in reality, if you're trading, Mick, you talk about time frame. For me, I'll just personal, if I'm day trading anything, I'm not touching my stops. I mean, that price is relatively valid. Unless market state completely changes, but that price is a valid price to me. If the market comes back to break even, I'm probably going to look and go, do I have more risk I can take? Can I add up? Can I size into this? As opposed to, oh, I'm going to get out because now I was in the money a little bit. Now it's come back. Like, that price is probably still extremely valid to me. The difference is my longer term stuff. If I'm trading in something for a couple of weeks, yeah, I'll consider. I obviously am going to be moving where my exit is. That's where it gets a little bit different. But on a daily time frame, I want to be in these trades. I want to give them the room to breathe. I want to take some heat, and I'm okay with that.
One of the most
Go ahead,
popular
John.
things people ask me is, how soon should I move my stop to break even? And I tell them not to. How many times have people come to me and say, I get a trade on and a market goes my way a little bit, so I move my stop to break even +1 to take the risk off. It seems 99 times out of 100 the market comes and hits that stop, and then I watch the trade play without me. It's because the trade is still valid. You haven't given the trade the opportunity that it needs to begin to even pay you a little bit. As far as trailing stops, to me, you're right. It is an art form, but I won't move my stop until I'm actually protecting some sort of profit.
I think it's fine to experiment with, but it should be something a little bit more than what you described there, Hogue, if something's a little bit in my favor, moving it to break even. I mean, say you had something where if you were going for a 2-to-1, reward the risk, and you moved yourself to break even once you got 1-to-1, right? Fine to experiment with.
As I'm continuing to think about this, maybe moving it to break even. If you're risking, 10 ticks to make 20 ticks, and that's, what you're doing on every single trade, maybe you would find that more beneficial. If you're someone who's looking to take a bigger bite out of the markets, you're going to need to give yourself more room. How many times do we see a market make new contract highs or new recent highs by, I'll use S&Ps, for example. S&Ps could make, a new high by 50 ticks. And then the following day, that daily bar has retraced, I meant 40 points or 50 points, make a new high by 50 points, but then the following day, the market's retraced 40 points, doesn't mean that you want to get stopped out if you have a longer time frame on it. It's not bad risk management to, scratch a trade, but it's something you really got to play with, I think, and get a feel for yourself. I don't think you could be guided in what kind of mindset to take as an approach, but I don't think you can be taught to do, if this, then that. You got to find it out yourself.
We have a couple more. If no one has to leave right at noon, we have a couple more quick questions. Jeff asked, do you have time limits for the trade to work? Like all these answers, it depends. I think there's nothing wrong, especially if you're taking oh, there goes Hogue.
We lost him again.
Oh, that sucks. The next question was for him.
He didn't like that question.
No, I should have given him the one for him. I think if you're going to hold on to something, if it's getting way longer than it usually does, if you put on a trade in the morning and then you're still waiting in the afternoon for it, I think you have to reevaluate it. So
I do have it in my strategy, like try and predetermine expectations on time for a trade to play out. If I'm looking for a quick breakout on a move, if I'm day trading and I want to see a quick move, it's pressing a level, I want to see that level break down, I'm going to be relatively short in that trade. I'm not going to sit there all day and see if it's going to break my level. If it's holding, and eventually doesn't break, that means that level has become resistant or it has become support, and I'm not going to see that break. And I want to get out of it because I don't like that. Other stuff, longer term stuff. Yeah, I'm looking at these certain prices and I may say, hey, I've got big expectations. I'm looking for a $10 or $12 move in the oil. I'll sit in that trade for a couple weeks with that expectation and looking for that price to, move. If I'm in it for 2 weeks on a trade and it's only moved $2, I'm probably going to start to consider getting out of that position.
Yeah, Dan, I think this.
Oh, real quick, Dan, I was going to say, because we got a couple more questions there, would you mind pretending to be Hogue for a second? Because I think you could probably answer this for Hogue.
Sure.
All right. Patrick asks,
I know Hogue well enough.
If you could have one indicator on a chart, which one are you taking?
So I'm gonna, in the words of Hogue, it's not necessarily an indicator. It's another way to look at the market, and that would be volume profile. I think if Hogue could just have volume profile, everything else would be perfect for him. If we're talking indicators,
He's all about the profile.
he's all about profile. John, that's his one thing. So John, I am speaking for you. You can correct me if I'm wrong, but I think he would choose of anything. It would be volume profile.
I think that's speaking what John would speak, Dan.
Yeah. One more question. Jonathan asks, I have been break and retest trading lately, which has been working out well, but the channel trading in between these levels is such a challenge. Any advice? Maybe just being more patient? Yeah, range trading's tough. Dan, you like channels.
It's funny, you talk about range trading, and I think that like newer traders, when you first get in, and Mick, correct me if I'm wrong, but you're looking for trending, and that's really where you start to find a little bit more profits. The range, it gets a little different, and the hardest part is defining your range and getting an idea of. And you guys have all heard me talk about channels. I mean, that is my bread and butter. I determine channels every market I'm trading. Daily channels, weekly channels, hourly channels, 4-hour. I'm looking at a lot of different things. And it's patience is key. Wait for that market to test a high or a low side of that channel before you enter. You don't want to get caught in the middle because it can go either way. Look for those extremes and fading those extremes.
Well put. Mick.
Or Ho, correct me. I said volume profile. It's market profile. I
profile.
see his comment in here.
Oh, he's got internet to make comments, but not to be on here with us.
Yeah.
I knew that's what you meant.
He's on his cell phone.
Yeah. Big baller trader with a 90s internet, Hogue. Anyway, it's great because he can't respond to whatever I'm saying here. I guess he can't in the comments.
Yeah,
So,
now's our time to say all the stuff we really wanted to say about Hogue.
Yeah, well, we love Hogue, but got to give him something. So that's all the questions, I think. Dan, do you have a quote to send us home?
I do. It says it's a Chinese proverb. I don't think this is, but if it is, then I'm wrong.
Well put.
If you don't want anyone to find out, don't do it. I think we've all been there in trading where you do something, you go, God, I don't want to tell anyone I just did this. And we've done that in a lot of places in life, but in trading, making those silly errors, you're doing them as you get into it. If you don't want to tell anyone about it, then just don't do it.
They told it. My first day at work, they said, you will flip a ticket. And I was like, absolutely not. I am so laser focused. I am so into this right now. But, you spend 12 hours overnight for a couple months and suddenly, boom, you do it one day. So we all make mistakes. Try and minimize them. And there's simple ways like not using stop limit unless you know exactly what you're doing with it. So hope that helps you out there. Mick, Dan, thanks for coming. Hogue, if you can hear me, we're still searching for you. Have a great day, everyone. We'll see you next week. Bye.